The U.S. markets are closed for the weekend. As of the closing bell on Friday, October 17, 2025, Rezolve AI PLC, trading under the ticker RZLV, finished the session at $4.87 a share. That was a drop of 17 cents or 3.37% to end the week. Now, that 3.37% drop occurred on very significant volume, with nearly 15 million shares changing hands. And this is precisely where the story of Rezolve AI becomes so compelling. The expectation for a company with AI in its name, one that just recently and very publicly raised its 2025 annual recurring revenue guidance to a massive $150 million and initiated a 2026 target of $500 million, would be a stock trading somewhere in the stratosphere. The expectation is that this should be a rocket, not a stock struggling to hold the $5 line. The reality is that this $4.87 price represents a battlefield. It is the tangible, real-time result of a brutal conflict between an extremely bullish management-driven narrative and a deeply skeptical market that is still digesting a recent short seller report and has a long, painful memory of post-SPAC implosions. Let's be honest about the general belief here, the common ground. Most retail investors, perhaps doing some self-investing on platforms like SoFi Invest or looking for the next big score on the Robinhood stock trading platform, see a ticker like RZLV and their eyes light up. They see the AI branding, they read the press releases and see the client list, H&M, ASOS, Ferrero. They hear about strategic partnerships with Microsoft and Google. They see management highlight 95.8% gross margins and 426% year-over-year revenue growth for the first half of the year. They immediately think this is their ground floor ticket. They're not just hoping, they are expecting this to be their chance to get in on a stock with a future growth trajectory like Tesla stock or Nvidia stock. They see the strong buy ratings from analysts at H.C. Wainwright or Maxim Group with price targets of $10 or $15, and it confirms their bias. The expectation is that this is a coiled spring. But the market and Friday's closing price is telling us a profoundly different story. Why does a stock with that kind of explosive guidance close the week on a 3.37% loss with heavy volume? The reality is that the market is questioning the source and the sustainability of that growth. A short seller report from Fuzzy Panda Research, which dropped just a few weeks ago, directly accused the firm of faking its annual recurring revenue growth through its acquisition strategy. The company, as you would expect, issued a very strong and immediate denial, calling the report misleading and self-serving. But the seed of doubt was planted. The reality is that the actual revenue for the first half of 2025 was $6.3 million. The leap from $6.3 million in a 6-month period to a $150 million exit rate ARR is astronomical. It's not impossible, but it is an extraordinary claim. The market, which has been severely burned by hundreds of SPAC merger companies over the last few years making similarly grand projections before collapsing, is treating this guidance with extreme prejudice. This isn't a buy-and-forget holding for a Fidelity brokerage account. This is a prove-it stock, and the burden of proof is 100% on the company. The high volume on Friday's drop suggests that for every buyer on the Robinhood app dreaming of a 100x return, there was a seller, perhaps an early investor or a sophisticated trader using the Interactive Brokers platform, who decided that $5 was a good place to take risk off the table. This $4.87 price is a focal point of contention. The stock's 52-week range, which stretches from just over $1 to as high as $8.45, tells you everything you need to know about its volatility. This is not a candidate for a diversified, set-it-and-forget-it Schwab Intelligent Portfolios strategy. This is a trader's instrument, plain and simple. The recent news flow has been a whirlwind, a perfect storm of conflicting information. On one hand, you have the company's official communications. They just announced the acquisitions of Smartpay and Subsquid to build out what they call an agentic commerce backbone. They also announced the elimination of a private placement warrant overhang, which is genuinely good news for the capital structure as it removes a source of potential dilution. And, of course, they beat analyst consensus on that H1 revenue figure. This is the narrative management is pushing, and it's a compelling one. On the other hand, you have the market's reaction. The stock is still down significantly from its post-guidance highs. The announcements of investigations from various law firms, which pop up like clockwork after any short seller report and subsequent stock drop, keep the negative sentiment circulating online. This is the inherent risk of online investing in highly speculative names. The story you read in a press release is rarely the full picture. The stock is simply acting like it has a heavy weight on it, and that weight is credibility. The market is in a wait-and-see mode. It is waiting impatiently for the next quarterly report to see if that 150 million ARR trajectory is real or a financial fantasy. When you see volume spike to 14.8 million shares on a day when the broader market is quiet, it shows a massive divergence of opinion. The capital flowing into a proven entity like Nvidia stock is from large institutions, perhaps being allocated by Fidelity Wealth Management or flowing into Fidelity mutual funds, all betting on a dominant, profitable, proven player. The volume in RZLV is fundamentally different. It's a high turnover, speculative churn. It's the bull case from the press releases versus the bear case from the short report. And all of this is happening in a macroeconomic environment that remains difficult. Even if the Federal Reserve is done hiking, the higher-for-longer interest rate world is brutal for unprofitable tech companies. A company like Rezolve AI, which has a negative earnings per share of minus 0.84 and a net loss of over 57 million, is valued entirely on its future earnings potential. When you can get a relatively safe yield from a bond, the discount rate you apply to those distant hypothetical future earnings gets crushed. This is why a company like Apple stock, with its fortress balance sheet, massive free cash flow, and stock buybacks, can weather the macro storm, while RZLV is tossed around by every shift in sentiment. The company doesn't just grow, it needs to execute flawlessly, and the market has absolutely zero patience for a misstep. So what is the actual business behind all this drama? This is critical. Rezolve AI isn't building foundational large language models. The expectation is not that they are competing with OpenAI or Google's internal projects. The reality is that they are an application layer company. Their core product, the Rezolve Brain platform, is built for e-commerce. They are now branding it as agentic commerce. In simple terms, think of it as an AI layer that helps brands like H&M or ASOS optimize their online search, customer personalization, and checkout processes. They also have technology for what they call trigger-based engagement. The idea that you can point your phone's camera at an ad on TV or a product in a store, and it will immediately initiate a purchase or engagement. This is why they acquired Smartpay and Subsquid to integrate digital payments and blockchain data into this new commerce ecosystem. The business model is B2B software as a service. They sell subscriptions to these large enterprise customers. That 95.8% gross margin figure, if it's accurate and sustainable, is the single most attractive number in their entire financial profile. It shows that if they can scale the revenue, the model is highly profitable. But here is the rub. This is an intensely competitive field. They are not just fighting other small AI startups, they are fighting the massive in-house AI and data science teams at their own customers. They are also competing with the platform giants like Shopify, Adobe, and Salesforce, who are all aggressively building AI features into their own ecosystems. Rezolve has to prove that its brain suite is so much better, so much more effective at lifting conversion rates that it's worth the complex integration cost and the ongoing subscription fee. The 100-plus customer list is a great start, but the market is asking what the value of those contracts is. Is it $150 million in annual recurring revenue? The market, by pricing the stock at $4.87, is saying, "We don't believe you yet." The entire bull-bear case hinges on whether you believe